The year 2024 will be etched in the memories of investors as a time of significant financial upheaval. It all unfolded in August, when global stock markets experienced a dramatic downturn. This wasn't just another dip in the market, it was a crash that sent shockwaves through the global economy. Investors were left reeling, wondering how it all happened so suddenly. The answer, as many analysts would come to agree, lay in the complex world of international finance, and at the heart of it was the yen carry trade. For years, the yen carry trade was a popular strategy among investors seeking to profit from global interest rate differences. Here's how it worked. Investors would borrow Japanese yen at incredibly low interest rates, sometimes even near zero. They would then take these borrowed yen and invest them in assets that offered higher returns, such as stocks and bonds in other countries, particularly the United States. As long as the yen remained weak against these other currencies, investors could enjoy substantial profits. It was a seemingly simple strategy that promised significant rewards, but it relied on a delicate balance that was about to be disrupted. The linchpin of the yen carry trade was the Bank of Japan's long-standing policy of keeping interest rates extremely low. This policy, aimed at stimulating the Japanese economy, had the unintended consequence of making the yen incredibly cheap to borrow. However, in July 2024, the BOJ made a pivotal decision. They raised interest rates. This seemingly small adjustment sent shockwaves through the financial world. For the first time in years, borrowing yen was no longer as attractive, and the foundation of the yen carry trade began to crumble. As news of the BOJ's rate hike spread, the yen began to strengthen against other major currencies. Investors who had borrowed yen suddenly found themselves facing a problem. Their loans, once cheap, were becoming more expensive to repay. This was particularly concerning for those who had leveraged their investments, borrowing heavily to maximize their potential gains. As the yen continued its ascent, brokers began issuing margin calls, demanding that investors deposit more funds to cover their positions. Section 5. A cascade of selling global markets tumble. Faced with mounting losses and the threat of further margin calls, investors had little choice but to sell their assets. This wave of selling began in Japan, with the Nikkei index plummeting over 12% in a single day. It didn't stop there. The selling pressure quickly spread to other global markets. U.S. stock markets, including the S&P 500 and Nasdaq, experienced sharp declines as investors scrambled to reduce their exposure and cover their losses. The global financial system, so interconnected and reliant on complex trading strategies, was thrown into turmoil. Section 6. The U.S. connection, tech woes, and a weakening labor market. While the unwinding of the yen carry trade was the catalyst for the August 2024 crash, other factors exacerbated the downturn, particularly in the United States. The tech sector, a darling of the stock market for years, began to show signs of weakness. Disappointing earnings reports from major tech companies shook investor confidence, leading to a sell-off in tech stocks. Additionally, a weakening labor market with rising unemployment and slowing job growth added to the sense of unease in the U.S. economy. Section 7. Beyond the yen, other contributing factors. The August 2024 crash was not solely a story of the yen carry trade. It was a confluence of events that exposed vulnerabilities in the global financial system. Interest rate cuts in the United States and Europe, aimed at stimulating their own economies, had narrowed the interest rate gap with Japan, further reducing the profitability of yen carry trades and accelerating their unwinding. Geopolitical tensions and uncertainty surrounding global trade added to the market's volatility, making investors more risk-averse and prone to selling. Section 8. Market volatility and the future outlook. In the aftermath of the crash, market volatility remained high as investors grappled with the implications of the BOJ's policy shift and the fragility of the global economy. Experts warned of continued uncertainty, urging investors to brace for further fluctuations in the months to come. The crash served as a stark reminder of the interconnectedness of global markets and the potential consequences of relying on complex financial strategies. Section 9. Conclusion. Lessons from the crash. The August 2024 market crash, triggered by the unwinding of the yen carry trade, highlighted the intricate and often unpredictable nature of global finance. It underscored the importance of understanding the risks associated with seemingly low-risk strategies and the potential for seemingly isolated policy decisions to have far-reaching consequences. As markets stabilize and investors rebuild their portfolios, the lessons learned from the crash will undoubtedly shape investment strategies and risk management approaches for years to come.